Good evening. This is Kevin Cumbus, President of TUSK Partners. Welcome to our December webinar. Today, we're going to be covering what private equity is looking to invest in now. Private equity has played such a critical role in the roll-up of the dental industry in recent years, and they are more active than ever. I am so pleased to be joined tonight with Maggie Jarrett, Director of Business Development for TUSK. Maggie brings a wealth of experience with her to our team because she not only has worked to buy side as a strategic buyer with McKesson, she also worked as a financial buyer with a private equity group that was focused a lot on the dental industry in recent years. So she brings this knowledge to us tonight, really an insider's look at how investors think about making investments inside the dental space. A little bit of housekeeping before Maggie and I get started. First of all, there is a window somewhere on your screen to submit questions. If you have questions that pop up during the presentation, please go ahead and type those in. If we are unable to get to your question tonight, we will certainly get back to you over email and set up a time to chat. But we want to make sure that everyone's questions get answered. So thanks again for joining us, especially during the busy holiday, hectic season that we're in. We look forward to spending the evening with you. So let's go ahead and get started. First off, a little bit about TUSK. Our team has a depth of knowledge that stretches across finance, investment banking, private equity, and multiple businesses that are focused on the M&A sphere, both inside and outside of the business of dentistry. On the left-hand side, you can see those companies that we have all worked with and for over the years, and also the business of dentistry, DSOs, and healthcare itself. So on the right-hand side, you see the logos of all the other businesses that we've worked with in our collective careers to get to this point. And really, TUSK lives in the middle of these two worlds, right? It's the investment banking world and the DSO dental world where we live and thrive. We are passionate about value creation in this space and are lucky enough to work with entrepreneurs and help them create multi-generational wealth events for them and their estate and their families. So it's a pleasure to get to do what we do. And if you have questions about what the value of your business is, don't hesitate to reach out to any of us. On this slide, you'll see our team. Tonight, I am joined with Maggie Jarrett. Maggie is the Director of Business Development here at TUSK. She is speaking with a lot of you regularly about what your options are in the market, but tonight she's going to put on a hat of a buyer. She's been a buyer before for strategics and financial investors in the space, and is kind enough to come in and spend the evening with me, really unpacking what a private equity group is, why are they investing in the dental space, how do they make money, what's the difference between an independent sponsor and a private equity group. I mean, on and on and on. I mean, there are 120 plus private equity-backed groups today, so anybody who's in this space needs this knowledge. And with that, Maggie, I just want to say thank you for joining me this evening.
Thanks for having me, Kevin. I'm happy to be here. I'm excited to share a little bit about my experience working for a private equity firm and serving on the board of our firm's DSO. So let's go ahead and get right into it. So, what is private equity? Private equity is private capital that is essentially not able to be publicly traded like a stock that you may own. Private capital is typically raised by a private equity firm. It's money committed by pension funds, institutional investors, and in some cases, high net worth individuals. These investors in private equity firms are called limited partners collectively. Private equity firms typically raise specific private equity funds that are based on an investment thesis they have done a ton of research to develop. This thesis is a set of beliefs or philosophy on which they make investment decisions. So a private equity fund typically has a 10-year life. It may be dedicated, maybe a healthcare fund within a generalist private equity firm, for example. So they may have a 10-year private equity fund dedicated to healthcare. And they're going to invest in about 8 to 12 portfolio companies, one of which may be a DSO. It may actually be your practice, right? If you are a dental practice that has 2 million of EBITDA or more, you are a candidate to be a portfolio company for a private equity group. You may have already been approached by a private equity group and given an unsolicited offer, right? What a private equity group is going to want to do with their 8 to 12 portfolio company investments is use the first 5 years to find those investments, um, and grow those investments. And then the last 5 years of the 10-year fund, they will typically exit those investments. They often call it harvesting those investments. They're going to realize the value by growing the investments, making them more profitable. Private equity, as we are referring to it tonight, is really that growth capital category, although the term is really much more broad than that. It includes venture capital, mezzanine debt, and leveraged buyout groups. So how do private equity firms generate returns for their limited partners? They're going to, buy low, sell high. How do they sell high? Well, they improve operations within a business to grow profit. They expand infrastructure and support growth, build scale and efficiency by executing on add-on acquisitions. Those are also often called follow-on acquisitions or tuck-in acquisitions. And that's how they scale each of their investments before they exit them in the last 5 years of the fund life. Typically, they're looking to generate a 3x return on capital for their limited partners over the fund life.
Maggie, this is Kevin. One thing we hear from private equity investors is they're looking for businesses that have the engine built, right? But they might be missing a little bit of infrastructure or maybe some scalable attributes, but primarily are missing the growth capital, the gas for the engine, right? Is that kind of you saw when you were looking at opportunities throughout the space? I mean, what were you looking for when you were looking to make your initial platform investment?
Sure. So when we were specifically looking at dental opportunities, right, we were looking for groups that not only had the right team in place, right? That's really important. You want to have the right leadership, but you also want to have a scalable infrastructure. So does the dental practice have corporate functions centralized? Do they have a real team, or is it one individual running the business on his or her own? Do they have systems and processes that can grow with the business? So for example, are all of their locations on the same practice management system? Do they have a centralized call center? Do they have billing and collections, either centralized or a consistent process across locations? If so, you think of that as a business that is more scalable in the immediate term versus another business that may have a lot of EBITDA, but it doesn't have any of that infrastructure built in place. So as an investor, if you're looking at a business that does not yet have the infrastructure, it does not mean it's not a great opportunity. It just means that you're going to think about the next few years really being focused on building in that infrastructure before you can then go scale the business. So it's a bit of a longer term, a heavier lift in a sense.
That's really helpful. Thank you.
Sure. And so, as we just said, private equity firms are looking for, first and foremost, strong management. This, especially in dental, right? It's a people business. And so you want to have a team that is leading the business, that the employees are behind, the associate dentists are behind, patients are behind, and they're really going to drive growth as the business scales. But you're also looking, why are private equity firms interested in dental in the first place? Well, number one, it's an attractive industry, right? Pretty predictable, stable revenues, in many cases, recurring revenue when you've got patients coming back in for, every 6 months for visits. Um, Dentistry has proven not only to be recession resistant, but also pandemic resistant. It's amazing how quickly so many of our clients bounced back after COVID. And that, investors have taken notice, right? So there were a lot of private equity firms in dental before COVID, and even more are now reaching out to us each and every day, asking whether we have opportunities for them to invest in new DSOs. Um, Lots of growth opportunities, right? Can we, add efficiency within the practice? Can we add doctors, add chairs, add days, add locations? Lots of ways to grow within dental. As an investor, you're of course also thinking about what are the risks and how do I mitigate those risks, whether it is payer risks and reimbursement risks. Um, you know, there are lots of risks to think about, and that's one of the factors that investors are looking at. And last but not least, how much am I having to pay to make these investments? Am I able to get an attractive valuation on not only my initial investment, but what are businesses trading for at scale? What we will go through tonight is that arbitrage that private equity groups are able to realize as they buy, you know, small dental practices, scale them, and put them together to create DSOs.
Hey, I love these thinking. I mean, private equity is looking to invest in healthcare. There are a lot of healthcare service industries out there. Dental has become the flavor du jour of in the last 5 years with more and more investment in it. But what I'm gathering from you is they're looking at all industries first and foremost, and then selecting dental to be active in. And then when it comes to dental, looking at specific portfolio business, or looking at specific potential platforms. There really is a lot of astute decision making going into this that's led them down the path to get to we want to invest in the dental economy.
That's absolutely right. And what you see on this slide is that across the 12 largest DSOs in the market, 11 of them are private equity backed. Pacific Dental is the exception. They have not raised outside capital. They are still privately owned. The other 11 are backed by large private equity firms. And this is just representative of the largest DSOs in the market. As Kevin mentioned earlier, there are over 120 private equity backed DSOs out there today. Each of those are scaling their investments, and there are more private equity firms looking to get into the dental space. One thing I want to mention, there are private equity firms reaching out directly to business owners within dentistry. You may have also received offers from what we like to call independent sponsors or fundless sponsors. They look a lot like private equity, but they don't have committed capital. They don't have a fund. And so as you receive, as a business owner, and as you receive offers from private equity firms, make sure you know what their capital source is. How large is their fund? Who are their LPs? And make sure they do have capital already committed to make investments and scale investments. Independent sponsors, there's some great ones out there. But what they have to do is once they sign up a deal, right, for lack of a better term, sign up a dental group to work with them, they then have to go find the funding. So, that can make for a longer process, in many cases, a failed process if they're not able to secure enough funding to do the deal. It just adds another layer of complexity. It doesn't mean it's not the right decision for some business owners, but it is something to be on the lookout for and make sure you fully understand before you go down a path.
Great point. Yeah, I'll add, we've worked with some of those in the past and had great outcomes. And we've certainly worked with people who've come to us to say, would you please represent me after less than savory outcomes, where they just didn't get deals done and were tied up for months and months and months trying to get that deal done. So we can certainly relate to that.
Yeah. And so what you see here is really just the consolidation of the dental market, right? So a few years ago, we saw about 75% of the market as private practice, single location um, businesses, and that's very rapidly declining. Not only because DSOs are scaling their platforms, but new private equity firms, as we've mentioned, continue to enter the market. Okay, so how do private equity firms make money? For themselves and their limited partners. It's often called arbitrage, right? So what you see here is 7 acquisitions that a private equity firm is making of various dental practices of various sizes. You know, acquisition 1 has $1 million of revenue, 200K of EBITDA. They're getting a 5.5x multiple on their EBITDA for a total purchase price of 1.1 million, and so on, right? So total invested capital by the private equity firm is just north of 32 million. What the private equity firm or DSO does, number one, they're going to try to grow revenue, right? So let's say in this example, they grow revenue by 5%. They're then going to try to eke out some additional margin by renegotiating supplies contracts, by renegotiating payer contracts, and so on. So they're going to eke out an additional 2% of margin in the business, taking the margin from 20% on average to 22%. So just with those 7 acquisitions, what they've done is taken the EBITDA from 5.3 million up to 6.1 million. And the real arbitrage comes because they are able to achieve a much higher multiple. In this example, a pretty conservative estimate of 10x multiple on their 6 million EBITDA DSO for a value of 61 million at exit. It's a lot of numbers I'm throwing at you, but what they've been able to generate is a return of north of $28 million on this investment of 7 dental practices. And they've done that by growing revenue, growing margin, and achieving a much higher multiple after they've consolidated these businesses and put them together.
This math really helps it come to light. I mean, it's interesting to see it that way without even the impact of bank debt or leverage on there, which I know gooses the returns.
Exactly. Yeah. Good point. Good point. And you know what that has led to is not only the growth of general dentistry DSOs, but now we're seeing specialty DSOs right and left. DSOs focused on orthodontics, endodontics, pediatric dentistry, and so on. And even the general dentistry DSOs are now adding specialty services into the mix. So as a specialist, historically, many relied on referrals. Many of those referrals now are being acquired and joining DSOs themselves. And once they join the DSO, they're likely going to keep their referrals within that DSO network, right? So specialists are starting to see their referrals dry up. They are now more active with direct-to-patient marketing, which is very successful for some, less so for others. And so that's led many specialists to consider partnering with the DSO or private equity firm. This is just a quick illustration of some of the specialty focused DSOs that are out there that are actively scaling today. Kevin, anything you want to add about specialty DSOs?
I'm just looking at the list here. I mean, Smile Doctors, I think, is in market right now. U.S. Oral Surgery just traded. U.S. Endo just traded. D4C is likely in market. Endo One's likely in market. Rodeo traded pretty recently. Specialty, I think, is coming to market. I mean, it's interesting. These are pretty new companies, and D4C's been around for a while, but many of them are already going from their first sponsor to their first recapitalization and second sponsor. I mean, this industry, the specialty specific DSO popped up, I mean, didn't exist really 4 or 5 years ago, not at the magnitude it's at today. And now you're seeing private equity, or the initial private equity groups already get a really nice return on their investment. Pretty incredible how fast the industry is changing right here before our eyes.
And you mentioned something that we haven't covered yet, which is they're exiting, call it, 4 to 7 years into their investment. So private equity firm within their fund will invest in DSO. They'll hold it for 4 to 7 years. And when they exit, they typically sell to a larger private equity firm, right? In some cases, they may take a business public. There are no publicly traded DSOs out there today. There may be soon. But what we have seen historically is they are selling to another, oftentimes larger private equity firm that will then take the business through another 4 to 7 years of growth before exiting themselves. All right, so what is practice worth, or how do we value practices? There are a couple ways, right? You may have heard of businesses selling based on a percent of collections, or if you've received offers from private equity or DSOs, you've probably heard it in terms of a multiple on EBITDA, or profit within the practice. We think about it in terms of multiple on EBITDA. And so what this image is really trying to illustrate is how the multiple typically increases as the EBITDA increases. So if you start out with $1 million of EBITDA, on average, those businesses are trading between 5 and 7 times. As we get, north of 5 million of EBITDA, we're seeing businesses trade 11, 12 times, and so on. It's not just the EBITDA that's driving the multiple. Specialty has an impact on multiple. Scalability has an impact on multiple. DSO or private equity firms' timeline has an impact on multiple. If they're early on in their investment, they may be willing to pay up to hit the ground running and build some scale quickly. If they're at the end of their investment, they may be willing to pay up so that they can put as much EBITDA into their business as possible before they sell. You can see at the bottom here that there are so many different financial and strategic drivers that impact multiple. It is not just driven by the numbers alone. And, it's really also about the story that you take to market, right? So are you telling a growth story? Are you, as the seller, identifying growth opportunities within your business and clearly laying those out for the potential buyers to make them eager to partner with you and eager to pay up if needed in order to win the deal? How competitive is the process? It also has a huge impact on the multiple, right? What we at TUSK see is on average, and one of the things that excited me when I joined TUSK relatively recently is that on average, TUSK has been able to increase the value of unsolicited offers when they're brought to us by potential sellers from 33 to 100%. And that's really by telling a compelling story, standing behind EBITDA, identifying all of the add backs, and running a competitive process. We've got multiple buyers competing for any given business. Okay, so this is a specific illustration, right? The last slide was just general multiples that we see across as EBITDA scales. I wanted to show you an illustration here of a practice that may look like yours, right? You've got 3 million of revenue, 600K of EBITDA. Let's say you contemplate selling to, another dentist in your community. Solo buyer may be willing to pay you 80% of collections. That's pretty good. Historically, practices were selling for 60, 70, 80% of collections. So, right, you're at 2.4 million for your transaction value, total transaction value. You may have already received an unsolicited offer from a DSO or private equity group. They may say, hey, I can beat that 80%. I'll pay you 100% of collections, or 5 times your EBITDA. When you receive an offer from a DSO, in many cases, they're going to want to split up that value into cash and equity. So they may say, I'll give you 2.4 million in cash, and the remainder you are going to roll into some ownership of the DSO. That equity will then grow in value as the value of the DSO as a whole grows. So we typically assume an average return of 2 times your rolled equity. And so what you see over here on the right is that total transaction value from a DSO unsolicited offer is much more attractive than that from a solo buyer because of the value. They're willing to pay more upfront, and the value of your rolled equity increases. So in this example, total transaction value is 3.6 million. You know, we believe we can beat unsolicited offers and have done so many times for clients in the past by making it a competitive process, telling that story, and adding value and identifying all of the add backs to stand behind an EBITDA that is as strong as possible. In this example, we're going to get you 4.2 million or 7 times your EBITDA. And then because you have more cash at close and your equity is worth more, you're rolling more into the DSO, you're able to grow a bigger piece of the pie and realize a total transaction value in this example north of 5 million. So, you know, we really believe in our ability to beat unsolicited offers, not only financially, but also structurally. And that's what I want to touch on next. So offer price, of course, matters, but these agreements and these transactions are, you know, hundreds of pages long, right? These purchase agreements are very detailed. There are a lot of terms that can really impact the attractiveness of an offer over another offer. So this is a list. I won't go into each of these. Kevin, is there anything else you want to add on this slide before we continue on?
No, I mean, you nailed it. Its structure matters just as much as offer price. And the way I like to say it is, if you let me structure the deal, I'll pay you 20 times your EBITDA right now. Just let me structure the deal. That's how important structure is when it comes to these types of transactions.
I think we've covered this, Kevin. One thing I'll say is, you know, we have an entire analytics team that, you know, spends a ton of time rebuilding a P&L from the ground up to identify every single penny that can be added back to maximize EBITDA before we ever take a deal to market. And that's really important, right? The multiple matters, but it matters on what EBITDA are they basing the multiple. So our analytics team, I think, really prides themselves on, you know, their attention to detail and their ability to stand behind the EBITDA that we take to market. Again, creating a compelling growth story is really important. And, you know, running a competitive process is what, you know, any good representative should do to get you maximum value for your practice. Couple of examples here. I already mentioned, you know, TUSK is successful in improving unsolicited offers, but it's not just the financials, right? We are holding sellers' hand the entire way through the sales process. Sales process typically takes 6 to 9 months. And during that time, business owners are, you know, not only going through a transaction, they're also trying to run a business, which has been their full-time job up until they start, you know, going through the sales process. And so doing that alone is really a heavy lift, and it's a meaningful time commitment. What TUSK tries to do is minimize the burden on the sellers. Obviously, it requires quite a bit of engagement and a lot of decisions that sellers need to make, but we try to do all of the behind the scenes heavy lifting to make it as easy as possible. So I hope that's been a helpful overview for everyone. Again, Kevin and I are more than happy to answer additional questions. We'll certainly follow up if there are any questions that came up tonight that we did not answer. You know, I'm thrilled to be part of the TUSK team. It's really fun to be on the sell side working with owners to help them realize value for these businesses that they pour their life's work into building and finding the right partners for them.
Maggie, I can't thank you enough. I always learn from you when you're sharing your perspective. You're steeped in buy side knowledge and what they're looking for and how they're slicing and dicing deals, and your knowledge really helps strengthen us and our business and our clients when going to market. So I really thank you for making time tonight and carving out time from your schedule for us. I am sure there will be some follow-up questions in the future. Thanks to you all who submitted any questions over the chat. We will certainly get back to you within the next day or so. And if you have any additional questions about the value of your business, what's going on in the market today, what your business could trade for, whether or not you have a good unsolicited offer in your hand, please reach out to Maggie. She would love the opportunity to chat with you. And with that, I'll say good night and happy holidays. It's been a heck of a year. It's been a heck of a year for all of us and a challenging and rewarding year. So take time to focus on your families and think about the future. And just know that we're very much looking forward to another exciting M&A market in 2022. Thank you all. Have a good night.